Solomon, welcome. Glad you could join us. We've got another presentation for you. Today we're talking about foreclosure, debt collectors, and the IRS. We're looking at a payoff demand, another payoff statement. Can't say it enough. If you're not looking at the numbers, big mistake. Numbers don't lie. I know attorneys are not so fond of numbers and they're steeped in a rhetorical discourse, but numbers don't lie, and the numbers are going to tell you what's really happening. It's going to tell the court what's really happening if you assume the court doesn't already know. We're talking about foreclosures, debt collectors, and the IRS. Who is the real party of interest? Who is bringing this claim, and who's getting away with just about anything they want? Well, I only know two, God and the IRS. Nothing beyond the Internal Revenue Service's reach. And I believe these are debt collectors. Attorneys are acting as debt collectors where the court is acting as a agent for the state, and the state is the tax gatherer for the Internal Revenue Service. I believe these are IRS foreclosures, and that would be for the amount of withholding due on COD income from the cancellation of debt by involuntary conversion. So let's take a look. So here we go. Let's take a look. Another demand for payoff. If what we find as auditors, we find in every file. I wonder if it's happening to your file. Take a guess. Anyway, we have a payoff date. Give you a little insight to how we audit. We look at the date of the payoff statement and the date of the alleged sale. A sale set for May 2nd, 2023 would tie in nicely with the demand for payoff for 5/1/2023. We'll look at and see if we have that somewhere, but that's what my guess is. What you don't have here is something that pertains to interest, and I'll show you what it is. First of all, we have a principal balance of $456,092.84. Interest $13,264.70. Hello. From what date to what date? How'd they calculate the interest? Do you see a per diem here? I don't. You see a daily cost of interest? Do you see the number of days? How'd they calculate the interest? Well, that's what they say it is, so just accept it. I won't. So we have Ameris Bank for closing, and the demand for payoff shows $13,264.70 for interest, and we have a late charge of $492.23. What the heck is a late charge? Is that for one payment? Borrower's down, I think, about 6 or 7 months. Is that for 6 or 7 months? What is that? I have no idea. So this is where we're going to focus our audit. The rest of it, I'm going to write it off to gibberish. And is there any meaning to the rest of it? I don't know. The payoff total amount is $475,458. I'm interested in the integrity of this payoff demand, and we're going to look at the principal balance and the interest and the late charge, see how those come together. I will tell you this much. When I'm going to make an allegation that there are two loans for an attorney who's representing a client, I'm going to represent there are two loans here. That zero usually is indicative of the actual costs right there, and that would be the first loan. These would be the other costs that would establish the second loan. Zero, I have found out, usually means it's a subtotal, but we're going to leave that alone for right now. By the way, if you look over here, I think it says good through 5/1/23. Well, at least we know that much. I was correct. Payoff's good through 5/1/23. So let's take a look at the audit. So we move on to the audit. What we use is a cutoff date, 5/1/23. We have that down there, verified. Balance $456,092.84, verified that. And we have interest of $13,264.70. What does that interest total? How did they arrive at that? I know that as a discount, it looks to be about 2.9, almost 3%. And that doesn't tell me much if it was treated as a discount, but that is what the 2.9% is, a fraction or a ratio of the balance itself. So what we did was we calculated a per diem, and my per diem is correct. They don't have one here. The per diem is $67.61. How do I know that's right? Because the borrower payment times 12 equals an annual rate of $24,696. So if we take this $13,264 and I factor it at 365.25 days, that'd be $67.61. Okay, and that would check. So $13,264.70 at $67.61 over 365 days does equal the annual payment, $24,696. And again, $67.61 over 365 days equals the $24,696. And of course, that worked out to be 196.18 days. I don't know why we carried that fraction out so far, but We got 196.18 days, and that ratio is 54% of the year, so that'd be 365.25. So we're correct. That represents the number of days from 5/1/23 payoff statement good back to 10/16/22. That makes sense. 10/16/22 would be a late fee on the 10/1/22 payment due for 9/1/22. And according to the borrower, yes, they haven't made a payment since 9/1 of last year, 22. So again, we affirm that we have a per diem. Nothing strange, nothing out of the unusual yet. And we have a month that we calculated off 30.43 days in a month. And if you calculate that times 67.61, we're dead on with the monthly payment, which is 258 monthly payment. If you annualize that monthly payment, take it times 12. That wasn't hard. That's secondary talk, annualize. If you take that monthly payment times 12, it gives you annual debt service of 24,696. And we use the actual rate. Now, we're going to reverse it. If you take the loan amount times your rate, that gives you your annual debt service. If I take the annual debt service, which is stated in the note, the monthly payment times 12, and I factor it or capitalize it at the note rate, look what happens. Our 456.092 balance went up to 707,621.78. The borrower was outraged when they saw this. Yeah, so something's not right here. There's not a fit. Because 24,696 at 3.49%, which is a fixed rate, capitalizes at 707,621.78. Sorry, guys, payoff's wrong. Or you're trying to get way more than the value that would be attributed to the borrower's debt. And it looks like you're trying to Mickey Mouse with the upcoming sale, which is, I think, in May 2nd, right? You're off, counsel, with your payoff demand. You're off by 251,528.95. Do that to other customers. Don't do it to my clients. We're going to check you on that. Your payoff statement is incorrect. You're off by 251,528.95. If I subtract that from what I capitalized, the 700,000, there's a note rate. There's a note. So I think you're treating this as a discount. That's what you're doing. You're taking a future value after the borrower's gone, making her pay for it now. That's why they call it a legacy loan. And you're discounting it by the amount back down to her actual note amount. And that equals, whoa, IRS claim, 35.5%. Who do you think's foreclosing here? Loan officers work for the court, where the court is the agent for the state, and the state is acting as a tax gatherer for the IRS, who are the debt collectors for the Department of Treasury. It's an IRS claim on COD income. What do I mean by that? 35% federal withholding. That's not a servicer. It's a withhold. It's a federal. It's not a servicer. It's a withholding agent. If we take the 456, take the 251,528, which is 35.5, IRS tax is about 35.6, up from 25% to 36.5. What we have here is, it says in a term, 18.47. Okay, what we calculated here is that the borrower's COD income, which is the conversion of the note at origination, they canceled the debt. Your debt was canceled. The property was transferred into trust to a trustee as a third-party member bank, and then converted into annual income over the next 18.47 years. This person's gross income attributed to her is $38,315.51 for withholding of $13,619.51 annually, for after-tax earnings of $24,696. Wait a minute, $24,696, that's the annual debt service. That's her after-tax income. This is what 1099s are based on. Verify that. Divided by 12, look what the monthly payment is, $2,058. And yes, indeed, that was the monthly payment right there, $2,058. There you go. There's something seriously wrong with this payoff statement. Its intent is to deceive the reader, and if it's going to go to court in a non-judicial state, in a judicial state, it's to deceive the court. But that would be hard to do if the court's up to speed on what's going on, and the court is acting as a tax gatherer for the state, and the state acting state would be acting as a tax gatherer for the IRS. This is definitely a claim by the IRS. So you can take all the mortgage fraud that you find in a file and these other cheeseball audits, you take all that mortgage fraud, bad assignment, bad this, bad husband, bad wife, whatever. It means nothing. In an IRS, there's nothing beyond the IRS's reach. And I think the IRS is looking for someone to pay off this tax of $251,528 and then take the house. I guess the question is, if a house was worth $456 today, would you pay $251 for it? I would. It's a good deal. But that doesn't mean that that is what is going to be required of the borrower, the consumer. What's required of the consumer right now is to bring this into court, show that she is being defrauded, or the IRS is up to its debt collector thing, and that she may want to post a bond for the 251 until the matter can be heard. But this is not a foreclosure. This is a collection account, and it's brought by the Internal Revenue Service. Okay, that's what we do in an audit. If we can help you, if we can be of any assistance, call us. I mentioned to you our number is 202-270-2641, 202-270-2641, and get us a payoff statement. If you don't have one, order it now, whether you're in default or not. Order the payoff statement. Let me see it. I also want to compare this to a servicing statement. There's gold in them noodles. A lot of information to be found. You don't need to go that fraud route. You don't need to go that bad assignment, bad notary route. You don't have to buy into some of the junk you hear on the internet about defrauding Americans, homeowners, this and that. What you got here is definitely an intent to, well, at the very least, to improperly characterize a transaction for the cancellation of debt by involuntary conversion into income and property, which was transferred into trust irrevocably, and it's going to remain there. There's more into why this is happening, but for right now, I wanted to show you what we found in yet another file. Payoff figures, no good. Let's keep going. So what do we make of all this? Well, you have a demand that lacks integrity. You have a demand suggesting that it's been overvalued by about $250,000, and that's concealed. That falls under a federal statute. I think it's 15G. I'll have to post that again. I posted it on one of my other programs, but the federal statute calls for a accurate payoff demand in delivered in a timely fashion. I know the 11th District a few years back ruled on it that the timeliness was not so much important as long as the demand showed on the face of it that there was an error or omission or there's something that stands out. Obviously, this stands out on the face of the demand for payoff. The payoff is incorrect, and the cost to the consumer is going to be over $250,000, which is taxable. So that makes a compelling argument for an injunction or to stay the matter. I'm not an attorney, I'm an accountant. Only an attorney can advise you of your legal rights and property, but I'm telling you what we do with other attorneys in our engagements. And it's more on the subject of engagement. If you want to hire us, get me the following, no cost. To do a preliminary review, I want to see a recent payoff statement from you. I want to see a recent loan servicing statement. And I want to see your HUD-1 if you have it, if possible, the HUD-1 closing statement. And of course, if you have any assignments, those are always valuable. I'll tell you later. And I'll probably do a presentation on the assignments and why it's important. Not for maybe the reasons you're thinking, but for other reasons. And we look forward to working with you. And we hope we can bring something new to your case. We won't take on a case unless we can bring something new and compelling to the argument. That would include my affidavit as an expert witness. So I think that wraps it up. Hang on. All right, I'll try and skip through the most important parts here. And this is from the 1099-S filing. I'm not sure if S is for a sale or exchange or if it's for the S Corporation. Could be for S Corporation. I got to find out for you. I'm surprised I don't know that. But anyway, it's for reportable real estate. Reportable real estate, what is that? It says generally you are required to report a transaction that consists in whole or part of the sale or exchange of money, indebtedness, property, or services which are paid for, or any present or future ownership interest, that'd be your right of reversion, in any of the following improved or unimproved land, including airspace, inherently permanent structures, including any residential, commercial, or in this case, residential property, condominium unit and its apparent fixtures and common elements, including land, stock in a cooperative housing corporation. That's what these trusts were formed. It's to move bad bank assets off balance sheet. They retain the deposit and they move the liability for that deposit off balance sheet into a trust. And they're operating as stock shares issued in a cooperative co-op, Chicago, New York. Anyway, we're talking about sales and exchanges. The sale and exchange includes any transactional properly treated as a sale or exchange for federal income tax purposes. That'd be for the cancellation of debt. Get on board, even if the transaction is not currently taxable as a capital gain. It should say that. For example, a sale of a main home may be a reportable sale, even if the transferor may be entitled to exclude the gain. There you go, under Section 121, but see exceptions later. Also, a transfer to a corporation that qualifies for non-recognition of gain, that would be a non-sale. Under section non-taxable sale to 351 is a reportable exchange. In addition, a transfer under a land sale contract, seller carryback financing. Your property was transferred into trust and is being sold back to you through a nominee, MERS. That's your equity being sold. It's a refund. You're buying back the lender's loan, the seller's loan, as an investor. It'd be reportable in the year in which the parties enter into the contract. Day one, ownership interest. And ownership interest includes fee, simple interest, life estates, reversion, right of reversion, there it is. Remainder, any remainder after you pass, and perpetual easement. It also includes any previously created rights to possession or use of all or part of any particular year. For example, leasehold easement or timeshare. Anyway, it goes on and it gives you all the information. I can provide you this information if you like. Get a hold of me, leave a comment. It has, this I found interesting. You know, I'm big on the Y2K, which we've discovered. It says such rights remaining term of at least 30 years. That'd be a 30-year mortgage from the day of origination, including any period in which the holder may renew such rights. Right of reversion determined on the date of the closing. For example, a pre-existing leasehold on a building or with an original term of 99 years. That's your Y2K, 12/31/99. And a remaining term of 35 years on the closing date is an ownership interest. That is wild. Do you believe that? However, if the remaining term is 10 years, it is an ownership interest. An ownership interest does not include any option to acquire real estate. And ownership interest also includes a contractual interest in a sale or exchange of standing timber. It doesn't apply here. A lump sum payment that is fixed and not contingent. Involuntary conversion, we're talking about cancellation of debt. And you heard me say involuntary conversion. A sale of real estate under threat or imminence of seizure, requisition, or condemnation is a reportable transaction. You're being taxed on the transfer of your title after the amount that you owed was paid back as cancellation of debt. The property sits at zero at time of foreclosure. You're arguing fraud. There is no fraud at a zero or under the IRS, but there is a right of reversion, the right to claim back your property. But I'm going to tell you where the facts are and where we can support our argument that these are IRS foreclosures. Let me show you. And yes, that does wrap it up. I can't thank you enough for watching. If you've watched this long, you're going to be that much ahead of the curve and the rest of the pack. If you want to go back and review it, I'm not doing this for hits. I'm doing this to help folks. Go back and play this even a couple of times until you start to absorb it. Trust me, if you watch it enough times, the light bulb will go on. If you know anybody, we appreciate the referral, and we're looking for business. We're not backed up yet. We have room for a few more clients. So I'd love to work with you. This is M. Solomon. Thank you so much for joining us. I'm your accountant, foreclosure auditor. Telephone 202-270-2641, 202-270-2641. And you can email me at secondary trade desk, just like it sounds, at gmail.com. Again, thank you so much for joining us, and make it a great day. Take care.